And it is a bloodbath on Wall Street today. Equity markets taking a huge hit, and that's before we get into the big story on the macro front for the week. But of course, that's exactly what we're concerned with here on Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And we're going to take a look at how the markets did last week. We're going to take a look a little bit at how they started this week, which of course was not the most auspicious of beginnings for risk appetite, to say the least. And then really focus on what comes next, because the violence with which Wall Street opened this week might yet pale in comparison with what awaits ahead once the big splash macro news flow really enters into the picture, especially since this week the focus really is on the market's favorite thing to worry about. That is, of course, monetary policy, especially in the United States. So let's quickly unpack what kind of a lead we come into this with from the prior week and get into the meat of things. S&P 500 managing a small gain last week, 1.7%. NASDAQ up fractionally as well, 1.5%. Interestingly, last week, we can see those gains, while they are the second consecutive week of gains and they give us a return back to December's swing highs in the major indexes, which of course we have since retreated from over the past 24 hours in very vigorous fashion. We did not see last week that those moves were motivated by anything on the macro front, at least not seemingly so, because last week's macro calendar was very quiet. And we did not have the kind of strong impetus from that narrative. To wit, we can see 10-year barely moved, 0.1%, 2-year only a touch lower on the yield there, 0.5%. The real big standout last week as far as macro relevant assets was the US dollar. It had a significant sell-off, in particular against the euro. Note the more yield-sensitive yen barely changed, 0.1%. Gold had a telling pop last week, second consecutive week of gains, 1.1%. And crude oil continues to march to the beat of its own drum, down 3.5%. But there really wasn't macro consistency. Gold was up, but then again, the dollar was weaker and yields were a little cooler, so that makes sense. But none of that seems to comport with stock markets, which leading into last week really preferred to have a more concerted move lower in yields if they were going to be motivated higher. In fact, we can see the week before last, a much stronger rise in equities, almost 3% apiece for the major indexes. And what that took was a move in excess of 2% on the 2-year and almost 3% on the 10-year, but a concerted move lower in yields. That was not what happened last week. And so we seem to have a bit of continuation, but equities seemed much more robust than the macro story's ongoing follow-through appeared to justify. And indeed, there wasn't much event risk to speak of. Things are very different when we start this week. And of course, the first thing to keep in mind is that equities very much fell out of bed. Now, they were much lower than they closed, but we have the S&P here down about 1.3, 1.4% on the day. NASDAQ down 2.76%, looking at the futures. Dow up a touch, having been down. Russell down almost a full percentage point. And the gain for the Dow here coming to about 0.7%. So needless to say, a much more violent start to the start of the week, and that's before the macro enters the picture. The story there seemingly linked to the appearance of a true competitor to U.S. dominance for AI infrastructure, this coming from DeepSeek, a Chinese firm. And the main story here seemingly that if the markets were extrapolating a large-scale AI build-out that would disproportionately favor one kind of set of suppliers, that maybe those assumptions are incorrect, because now we have a competing model that is maybe as good as the US-based ones at targeted tasks, is cheaper to deploy, but perhaps more expensive, at least in terms of energy cost, to run. That's a conversation that's going to be unpacked over the weeks and months ahead. But one thing we can say is, if the implication of the pricing in the S&P and in the Nasdaq until this adjustment was there will be a very steep on-ramp of, let's say, more NVIDIA hardware for the world to buy, maybe that on-ramp isn't quite so steep. Now on to the macro risk. We begin relatively benign in Australia. The expectation here that the consumer price index, the headline quarterly number, is going to come into 2.5%. That would be for the fourth quarter, and it would also be the lowest reading that we've seen since the first quarter of 2021, so almost 4 years. Now, that might set the stage for a more dovish RBA, but how much more dovish is, of course, the critical question. And if we look at the way that policy expectations are implied here for the world's major central banks over the course of this year, you can see here is the RBA kind of in the middle of the pack. This is 100 basis points. This is 50. We're sitting somewhere around 63 or 65 basis points here for the RBA, implying that we are going to get at least 2 cuts this year, and that the likelihood of a third one is somewhere around 40%. A very similar story to what we have from the Bank of England, a very similar story to what we have from the Bank of Canada, which is also announcing rates this week. More on that in a second. The real question for Australia, though, is, do we get a set of numbers here that meaningfully alters the calculus? And the path of least resistance seems to be no. Citigroup data suggests that Australian data outcomes have hewed relatively close to expectations over the past several weeks and months. Moreover, the PMI data that we got last week seemed to speak of returning inflationary pressure both for inputs and outputs in January. So the RBA, which already had a somewhat hawkish bias relative to other major central banks, seems unlikely to jump out the dovish window on this. So whatever numbers we get here, as long as they are broadly close to expectations, seems unlikely that we're going to change a whole lot when it comes to the RBA on their basis. If there is a level of relief here, then the Aussie dollar, which was a little bit underperforming relative to the greenback against the backdrop of the risk aversion today, relative to, let's say, the euro or the yen, it might get a little bit more of a leg up once this event risk is out of its sights. As we just alluded to, the Bank of Canada is announcing rates this week, and we can see that the expectation is that by February here, this is a month in which we don't have a policy meeting, we are already going to be 18 basis points toward a rate cut, implying that we are probably going to get one this week. In fact, the probability of one is currently priced at not quite 80, but close to 80%, something on the order of 76, 75% chance of the cut. That means that the cut itself is probably not the biggest deal as far as market moving potential, because it's already in the market for the most part. The main question will be on forward guidance. And that's, of course, because Canada's economy remains in the doldrums. These are the latest set of PMI numbers. And really the main takeaway here is to consider that in the logic of PMIs, as ever, 50 is neutral. So here we see is where the sort of break-even line on economic activity is. Above 50, it's growth. Below 50, it's contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. Note that going all the way back to the second half of 2022, there has been but 3 months where we had meaningful readings above 50. Perhaps 4, give or take, with this slightly more extended period here. But we have certainly spent a lot more time below 50 over the past now almost 3 years than we did above it. And that, of course, is a very significant indictment of Canada's economy at a time when its biggest trading partner, the U.S., is booming. We, of course, know that 80% of Canada's exports are bound for U.S. markets, but the nature of U.S. growth in this booming period seems to suggest that we are not seeing that demand spill over. And we spoke at length last week about the danger of this kind of a configuration for the global economy, where there's essentially a single point of failure, and that is the U.S. economy, and its burgeoning demand isn't traversing borders. Take a look momentarily why. But in that sort of a scenario, Canada becomes ground zero for maybe a change. Maybe finally U.S. demand starts to reach overseas and start to lift boats outside of the U.S. borders. And if you were going to get some sort of reasonable, cogent commentary on what that looks like, the BOC would be the place to go. And so what might be more interesting in this BOC announcement than the policy decision itself is the path forward, and whether the central bank lays out the case for more easing, less easing, about the same amount of easing over the course that follows. And of course, at this point, we are priced in for, again, looking at this this move here, about 2 cuts with some possibility of a third by year end. So if we note here, we're looking at expectations for give or take 60 basis points by the end of this year. Here's the Bank of Canada clustering with the RBA and the BOE right there. Now, why is it that U.S. growth is staying domestically? Well, that'll be shown in spades in economic data that we have coming out of the U.S. this week. Of course, that isn't likely to be the focus, but we'll start here and work our way backwards. This is Friday's U.S. PCE inflation data. And the takeaway here is, of course, that most inflation lives in the core services part of the mix. And services tend to be serviced by domestic firms. So while the U.S. is booming, it is domestic demand that's booming. And this is why the U.S. is able to grow as robustly as it is. Meanwhile, the other major engines of global growth, the Eurozone and China, are on significantly softer footing, and why the world economy is operating, as we've discussed for a few weeks now, if not longer, without a safety net if the U.S. economy were to misstep. But a misstep is not what's seemingly on the menu here. U.S. GDP data is also coming out this week. There's a bit of a cool down expected from the first look at fourth quarter data, 2.7% annualized growth, down from 3.1 in the third quarter. But that is still very quick relative to what is normal for the U.S. economy. And of course, we know that U.S. economic data has tended to register somewhat upbeat relative to forecasts. Last week's strangely disappointing PMIs notwithstanding. So we're in a space here where we probably don't have a tremendously negative lead on the business cycle itself, which of course brings us to the Fed policy announcement, probably the tentpole for event risk this week. Expectations are overwhelming that the Fed will not change rates this time. We're sitting at 97.3% priced in probability that the policy rate remains unchanged in the 425 to 450 basis point target that is currently there. In fact, the soonest that the rate cut that is already baked in for the start of this year's easing cycle seems to be May, perhaps, but the likelihoods really get significant when you get to June. So looking at the situation currently, we can see the U.S. already expected to be the least dovish of the dovish bunch. The BOJ, of course, you can see is above zero here. They're expected to narrowly raise rates this year. The least dovish after that is the Fed, where we're not even pricing in the Fed's own forecast of 50 basis points at the moment. The market's a bit shy of that at 40 basis points here at today's close. So really the question for the Fed is, with the economy relatively upbeat, with no immediate data to suggest that things are falling apart in quick succession, what's the Fed going to say? In looking at what might matter here, the interplay between fiscal and monetary policy might actually be the most interesting. We've heard from President Trump last week that he believes himself to be a great barometer of what is appropriate for monetary policy and favors seemingly a dovish perspective. That might clash with a Fed that has been walking back dovish intent since mid-September and that looks at the markets here and says, well, we said we were going to slow walk this. Nothing has materially changed. We're still looking at about 50 basis points in cuts this year. We're not going to get any more dovish. And we are certainly open to becoming even less dovish if we have to, if inflation is stickier. So where that sets up a clash between the monetary and the fiscal functions for economic policymaking is likely to be very interesting for markets. And of course, after a painful day like today, they might be on edge for signs of acrimony that ultimately make what could be the need for quick response, were there to be any kind of crisis, a more complicated sort of situation. And finally, there is the ECB, which also has a policy meeting this week, as though we didn't have enough monetary policy risk on the board. We can see that by March, we are already at 2.5% on the implied futures curve relative to 3% here. This is a little bit misleading because the policy announcement is very late in the month of January. So this reading of 2.92 on January, only 8 basis points removed from 3%, obfuscates somewhat that we are pricing in a cut and that this cut is overwhelmingly on the menu. So the implication here is that by February, which is not a month when we have a policy meeting for the ECB, we'll already be down another 25 basis points. There will already be a cut. And when we look then at what's there by March, we're already at 2.5, implying another cut already on the menu by then. There's a third cut in June, and it looks like we land at a fourth cut spaced out toward the end of the year, perhaps as soon as September or October. But we can see that between the start of the year at 3 down to December, there's 100 basis points in cuts here. And indeed, we can see again from this matrix of overall major central banks, the ECB is the most dovish of the bunch. Now, this, of course, sets up asymmetric risk in the other direction because, indeed, to get any more dovish, you would need some sort of evidence to suggest it. And what we saw last week was, in fact, a push in the opposite direction. The PMI numbers that we saw last week for January gave us a much stronger view of the situation than anticipated. We were looking to still be in contraction territory for a third consecutive month. Instead, we saw growth in January. Moreover, it was the fastest expansion. This is the composite PMI, so this is manufacturing and services together. We saw the two collectively have the fastest expansion since August. So we're looking at perhaps a picture for the ECB that does not yell out for even more stimulus. There is a set of GDP numbers that are coming out, and although the expectation here is that on a quarterly basis, we're going to see a bit of a slowdown from 0.4% to 0.1% for the fourth quarter, the trajectory we can see since basically the middle of 2023 going into the beginning of 2024 has been toward very cautious improvement. In fact, if we take a look at year-on-year numbers, the expectation is that we're going to get 1% year-on-year growth in the fourth quarter, which would be the fastest for the one-year measure since the first quarter of 2023. So slowly but surely, a little bit of a green shoot, and perhaps, again, enticing of the view that the ECB doesn't need to get priced for any more easing beyond what's already there. So we, of course, had a sizable rally in the euro last week. We might be looking at more of that here, and a generally less constructive dollar story around it, both with a Fed that perhaps doesn't do a whole lot to alter policy expectations and is more impactful in terms of its sentiment lead, depending on Mr. Powell's post-meeting conversation, and an ECB that maybe isn't as dovish or doesn't need to get any more dovish than what is already there, all of which is the ingredient for the dollar to get a little bit weaker against the euro still. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise on with Chris for Futures Power Hour, Mondays and Fridays, on with Victor Jones for The Price of Truth on Tuesdays, back with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter, as well as on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.